In this video, we're going to look at how you can compute future value, present value, and your monthly mortgage payment using the TVM solver. That's the time value of money application that can be found on TI calculator, 83, 84, 89, and others. I'll be using the TI-84 on this one. So let's look at the first problem. Now there are formulas you can use for these, but I'm going to do this. I'm going to work these problems on the TVM application. We have $2,500 is invested at 4% compounded quarterly for 5 years. How much is in the account at the end of the 5 years? That is, what is the value of the account? And the $2,500 here represents present value. Okay, that's the value of the account right now, in the present. So what we want to know is the future value. So go to the calculator again. TI-84 plus Silver Edition virtual calculator. So I hit the apps button right here. Finance is already highlighted, so just hit enter. We want the TVM solver. That's number 1, so hit enter. And here are the variables. Now all of these have to have an entry. If it's not being used, you can just put a 0. If you clear it and leave it blank, and you try to move through the different categories, you won't be able to do it. Okay, so in this case it wants N. N in general could be the number of payments, number of interest periods, and so forth. So in this case we have 5 years, interest compounded quarterly. That's 4 times a year. So 4 times 5 is 20. I just put 20. You could put 4 times 5, 20. And then you can hit enter or just hit the down arrow key to move to the next category. The interest rate is 4%. Notice on the left it has I and then the percent sign. So it's understood that what you have on the right is already 8%. So don't put it in decimal form, don't put the percent sign, just put 4. Hit enter. Move to the next category. And PV is the present value, which in this case is $2,500. So we just enter 2,500. Okay, the next one is the amount of the payment. That doesn't apply here for this type of problem. So just go to the next one. Okay, so what we're looking for is the future value. So that's where we want to leave the cursor eventually, but we have to fill the next category. So this one here, P/Y, is number of payments, or number of payment periods per year. So in this case, it's compounded quarterly, 4 periods per year, so just enter 4. And for these types of problems, these two, the next one is compounding periods per year. These are going to be the same for the problems we'll be working. So just hit enter again and enter a 4. And actually, if you don't enter anything there and you scroll up, that will automatically change. Okay, so we go back here to future value, and then the calculator, on this particular calculator, we hit the alpha key and then enter. That's solving the problem. So we're trying to find the future value. So hit enter, alpha, and then enter. And there you have it. Negative 3,050 and 48. Now again, if the present value, you enter the present value as positive number, the future value will come out negative, and vice versa. So notice if I put a negative here, enter say negative 2,500, and then scroll back down to future value, hit alpha, enter. Notice it comes out positive. So if you just want to ignore that, ignore the negative sign, the answer is still going to be 3,050. 3,050 and 48 cents. Okay, let's go to the next one here. Find the principal needed. Now when it says principal needed, that's actually asking for the present value. To obtain 900 after 4 years at 3.5% compounded monthly. Okay, so they're asking in 4 years you want to have $900 in your account, or in a specific account. What can you invest now or deposit now in that particular account at 3.5% compounded monthly in order to have that $900? Okay, so let's go back to the calculator. Hit the app key here, finance. Okay, then again hit enter again to access the TVM solver. Now again, it has the values there, so there's no need to clear here. We can just simply enter the new ones. Okay, so in this case, we have 4 years compounded monthly, so that's a total of 48 periods. So that's in. This will be 48 for the first one. Interest is 3.5% compounded monthly. Okay. So the next one stays at 4%. Again, leave it just like that. Don't change it to a decimal, put the percent sign. Now in our case, we're looking for present value. So you can leave it the way it is here. I'm just going to set it at 0. The payment is not used in this one, so I'm just leave it at 0 there. And the future value is 900. Compounded monthly, so the P/Y, then it's going to be 12 pairs per year. And notice if I just scroll up, the CY or C/Y will change to 12. Those usually are going to be the same. Okay, so now I'm looking for principal or present value, so I scroll up to PV and hit the alpha and then enter. And actually this was 3.5%. Okay, wrong one, so it's just 3.5. So again, same thing, go to present value. Okay, I'm going to leave it like that and resolve it and see if we get the correct answer. So everything else is correct. Hit alpha and then enter. And there it is. Again, you can ignore the negative if you want here and just, it's 782 to 2 places here, 0.58. So 782.58. So that tells me then if today I deposit $782.58 into an account that pays 3.5% compounded monthly, in 4 years the account will grow to $900. Okay. Now let's go to the next one. Okay, after a down payment, your mortgage on a new house is $200,000. Okay, so you're going to buy a new house. The loan is for 30 years at 3% compounded monthly. What is your monthly payment? Okay, so again, we're just computing the monthly payment, so just keep in mind that to that you're going to have to add, for the year, you have to add property tax, homeowners insurance, and some other fees. Okay, but right now, what's your main mortgage payment? I'll go to the calculator. Again, I'm just going to enter the values over the previous values. So this one's for 30 years. It's compounded monthly, 12 pairs per year. So to find the value of n, you take the number of years, 30, multiplied by the periods per year, that's 12. So that's going to be 360. That'll be 360. Interest rate is 3%, compounded monthly, but we just enter the 3. Okay. And in this case, the present value simply represents the cost of the house or your starting mortgage. So this will be $200,000. Now here we're looking for the payment. What's going to be our monthly payment? So we'll leave that at 0. Future value again is not used in this one, so we'll leave that one at 0. And we want the other two categories to be at 12 because it's compounded monthly. They already are, so we leave it there. And then we scroll up to payment, which is what we're looking for. So again, hit alpha and enter, and there it is. Again, you can ignore the negative for now, and it's your monthly mortgage payment will be $843.21. $843.21. That's dollars. Okay, that's your monthly payment. Now you can actually compute the actual interest that you're going to be paying in the long run over the 30 years if you want to go 30 years by multiplying the number of payments, 843.21 by 360, and then subtracting 200,000. And that tells you what's going to be the interest that you pay. Now remember, to that you're going to add property tax, insurance, and whatever other fees you got to pay there in your state. Again, there are formulas that you can work these also, and I've done some of these in the past. But for right now, this is using the TVM application on this particular calculator. Thanks for watching. We'll see you next time.